Hi, my name is Z with the Aion Finance. Today we're going to be doing analysis on the FOMC, in particular FOMC meetings where we're not expected to change the federal funds rate, and seeing if we should be getting bullish, bearish, where are the best opportunities in the options marketplace. Let's begin. As an introduction, Aion Finance is all about looking in the past, finding similar situations as today, and looking at what performed really well in the past to guide us to finding the best risk reward to put on in the current environment. So the question is, when there is no expectation for a change in rates, how should we trade the Fed? Should we be going long? Should we be going short, buying calls and puts? And if we do, which strikes and expirations should we use? We're really going to get into the details and looking for some good trades. So let's begin. The methodology, what we're going to do is we're going to look in the last 10 years for all FOMC meetings where the Fed is not expected to change rates. And most likely they didn't change rates because the FOMC does what the market expects it to do the vast majority of the time. We're going to simulate buying calls and puts one day before the meeting, and then we are going to hold them into expiration. The calls and puts are going to be between 1, 4, 7, 14, 28, and 42 days to expiration at 10, 30, 50, 70 delta. We're going to be talking in terms of delta today because it is a way to normalize the distance between the at the money and the strike price of the option across all of time. For example, 50 delta is basically a short way of saying this is an option that is at the money, purchased at the money, regardless if SPY, the underlying, is trading at 602, which is what it's doing today, or if it's trading at like 200, which is what it was doing, 10 years ago. What we're going to do is we're going to take every option that we purchased, and we're going to settle it to cash at expiration, and then we're going to aggregate the results by days to expiration and delta. And the whole idea is to find days to expiration and delta combinations that perform the best during these specific times in the past. Jumping into the federal funds rate for the last 10 years, you'll see that first there's 8 FOMC meetings in a year and over 10 years, so there's 80 occurrences. Out of the 80 occurrences, roughly about half of them, the FOMC has kept the rate unchanged, and that has happened coming out of COVID for the most part, during the bull run in 2023 and 2024, and a little bit in 2016 and 2019 as well. And I mentioned this before, you'll see that in general, the FOMC will do exactly what the market thinks it will do. So, this is investing.com. There's like a forecast and then an actual, and very, 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 very infrequently does the FOMC actually surprise the market with a move. So jumping into the product, here's the model setup. So what we're going to do is we're going to look at the top 10,000 data points. So there are, 80 meetings, about half of them, so 40 meetings are within this analysis. In each one of the 40 meetings, we're going to get a data point every 30 minutes is how the platform is set up. So there's only about 500 data points. So this is basically capturing all of the data points, which will mean that the matching here will not matter between 2016-06 June. The reason why I do most of my analyses starting from 2016 June is because that's when SPY weeklies were introduced, and we get a lot more data points and liquidity at that point in time. And then here are the 40-ish some days, which are the one day before the FOMC meeting dates, where the FOMC meeting dates had no change in rates. And then we're going to analyze options pricing for SPY. So this graph basically indicates all the situations that we're looking at with the little red line right here. And you'll see they're basically all in an uptrend for the most part. And that's because when the FOMC holds interest rates constant, it's because the economy is humming along and they don't see, they don't see the need to kind of nudge the economy one way or another, either controlling inflation or boosting employment. So that generally means that the market is in a bull market. That's just like a little something to consider, and that's kind of verified by the P&L result grid that you see underneath here. So what you see here is the aggregate performance of an option categorized by their delta and their days to expiration. So for example, in the 481 situations where we purchased a 1 DTE at the money 50 delta call, we had an average P&L of negative 2.7%, and a win rate of 34.7%, which means that this 1 DT 50 delta call is actually extremely well priced by the market, and that it's very close to having a 0% P&L. This is contrasted to for the rest of the 10 years, where overall in the last 10 years there's 18,000 occurrences of buying this call, and that had produced an average P&L of 1.2%. So it's actually really inconclusive if it is better to buy a 1DT call during these kind of days, or as compared to just a normal day, a normal trading day in the last 10 years. So the results that you see here are in general pretty representative of what you will see in a bull market, in that all out of the money puts are going to be negative in average P&L. Because we're going up, we're in a bull market, puts are not going to pay out. In the meantime, in the short term, the expected values of your both call and put options are kind of variable, but relatively low on both the positive and the minus side. But as you go farther out in time, it is very likely that the market is going to be moving up, and some of the best options to buy are 28 to 42 DTE. Days to expiration at 30 delta as opposed to at the money, which gives you the best risk reward. So this is just kind of a very, very standard bull market result that you see here, which kind of makes sense. Like I said before, we are in the FOMC, which has a lot of information, thinks that we're in Goldilocks in terms of unemployment and inflation. And that generally breeds bull markets. So some of the, so I would look at some of these 30. Generally, the reason why the platform prefers 30 delta calls as opposed to 50 delta calls is because they're significantly cheaper, but they offer you almost the same amount of upside with not that much theta burn. So definitely something to look at if you want to finance them with some closer to the money, closer to the current date expiration calls, like selling, some 4DT 10 delta calls to create a spread that is a little bit cheaper, where you are still making a directional bet, but you're giving up a little bit of the upside in the immediate term for some data burn and some safety. In the credit outlay that you're performing. That is an option as well. But yeah, this is kind of pretty straightforward analysis of the FOMC and how to trade it. So thank you for staying with me to the end of the video. Please like and subscribe if you really enjoyed this content. I try to put out something informational at least once a week, doing back tests, looking at history and seeing what works. So yeah, I hope to see you in another video. Okay, bye.